The richest men on earth just did something they've never done before. And if you don't understand what it means, your savings could vanish in the next 18 months. Between February and November 2024, the world's wealthiest individuals sold over $50 billion in stock. Not quietly, not gradually. In massive ... coordinated transactions ... that set off alarms across Wall Street. Jeff Bezos sold $13 billion in Amazon. Mark Zuckerberg sold over $9 billion in Meta. Jamie Dimon, CEO of J.P. Morgan Chase, sold stock for the first time in his entire 18-year career. Larry Ellison unloaded $3 billion in Oracle. The Walton family dumped $2.3 billion in Walmart. NVIDIA insiders ... riding the AI boom to all-time highs ... sold over $1.2 billion ... while telling the public ... the best is yet to come. This isn't portfolio rebalancing. This isn't estate planning. This isn't tax optimization. This is an exodus. The smart money is running for the exits. And they're doing it at the exact same moment. Using the exact same playbook they used in 2007, right before the financial crisis destroyed $16 trillion in wealth ... and crashed the market 57%. I'm Walter Grant, and welcome to Draxiver. Today, I'm going to show you exactly who's selling ... and how much. The 5 historical patterns that prove insider selling predicts crashes with near-perfect accuracy. What metrics these billionaires are seeing that you're not. Why 2025 and 2026 could be the most dangerous setup since 1929. And most importantly, what you can do right now to protect yourself before the cascade begins. Because this isn't a prediction. This is pattern recognition. And the pattern says you have 6 to 18 months before everything breaks. Here's what most people miss. These aren't ordinary investors. Jeff Bezos built Amazon from a garage into a $2 trillion company over 30 years. He's lived through the dot-com crash, the 2008 crisis, COVID ... and he never sold like this. Jamie Dimon has been CEO of America's largest bank since 2005. He survived 2008. He's seen every crisis. And in 19 years, he never sold a single share. Until now. These men don't panic. They don't make emotional decisions. They operate on data, ... analysis, and perfect information that you and I don't have access to. And right now, that data is telling them something terrifying. Get out. Now ... Before I show you the specific sales, you need to understand what insider selling actually means and why it should matter to you. Insiders are corporate executives, ... board members, and major shareholders who have access to non-public information about their companies. When they buy or sell stock, they must report it to the SEC within 2 business days. These reports are public. Anyone can see them. But most people don't look. Why does insider selling matter to your life? Because insiders know more than you. Jeff Bezos doesn't just see Amazon's quarterly earnings report like you do. He sees daily sales data, margin trends ... competitive threats, internal forecasts ... problems developing before they hit earnings. Jamie Dimon doesn't just read about the economy. He sees J.P. Morgan's loan default rates in real time. Commercial real estate delinquencies, credit card charge-offs, corporate bankruptcies. This is non-public information that won't appear in the news for months. And when insiders see trouble coming ... they sell. The data on insider selling is tracked by multiple firms. The most comprehensive is the Washington Service, which has tracked insider transactions since 1975. They calculate something called the insider sell-to-buy ratio. This measures how many dollars of stock insiders are selling ... versus buying. A healthy ratio is around 2 to 1 or 3 to 1. Insiders sell twice or 3 times as much as they buy. This is normal. Executives get paid in stock. They diversify by selling some and keeping most. They have personal expenses ... taxes. Estate planning. A 2 to 1 or 3 to 1 ratio is business as usual. But when the ratio spikes above 5 to 1 it's a warning. When it hits 8 to 1 or 10 to 1, it's a screaming alarm. In 2024, the ratio hit 9 to 1 for the year. In certain months, it spiked to 12 to 1. Insiders are selling $9 of stock for every $1 they're buying. This is the most extreme imbalance since 2007. And you remember what happened in 2008. Now let me show you the specific names and numbers, because the scale and coordination are unprecedented. Jeff Bezos Amazon. In February 2024, Bezos announced plans to sell 50 million Amazon shares. The stock was trading around $170 to $175 per share. He executed these sales throughout February and March. Total value approximately $8.5 billion. Then in July 2024, Bezos filed another selling plan for 25 million shares. Amazon was trading around $180 to $190. He executed throughout summer and fall. Total from the second round, approximately $4.5 billion. Combined 2024 sales over $13 billion. Let me put this in context for you. Bezos founded Amazon in 1994. For 30 years, he's been the largest individual shareholder. He's sold stock before, but never at this scale and never this fast. His previous largest sale was in 2020, when he sold about $10 billion over the entire year to fund Blue Origin. But that was spread over 12 months. And during COVID crash recovery when stocks were cheaper. The 2024 sales are different. Concentrated, massive, at all-time highs, and his public explanation? He moved from Washington to Florida to save on state income taxes. But here's what doesn't add up. Bezos has been a billionaire since 1999. He could have moved to Florida any time in the last 25 years. He chose 2024, when Amazon is at a $2 trillion valuation and the market is at records. This isn't tax planning. This is market timing. Mark Zuckerberg Meta. Throughout 2024, Zuckerberg executed multiple stock sales under prearranged trading plans. In January, he sold 200 million. In February, 400 million. March, 550 million. The sales continued monthly. By November 2024, Zuckerberg had sold over $9 billion in Meta stock. This is notable because Meta stock more than tripled from its 2022 lows of $90 to over $500 by late 2024. The company's market cap surged past $1.3 trillion on AI hype and efficiency improvements. And at the peak, Zuckerberg is selling billions. The official explanation? Funding the Chan Zuckerberg Initiative. His philanthropy focus on education and health. That's possible. But Zuckerberg controls Meta through super voting Class B shares. He has 61% voting control with only 13% economic ownership. He could hold his stock forever, maintain control, and fund philanthropy through borrowing against his shares at 3 to 4% interest rates. Instead, he's selling at the fastest pace of his career, converting Meta shares to cash. Precisely when the stock hits records. That's not charity. That's exit timing. Jamie Dimon. J.P. Morgan Chase. This is the most significant signal of all. Dimon became CEO in 2005 for 18 years. Through the 2008 financial crisis, the European debt crisis, COVID. Every market crash and recovery. Dimon held every single share of J.P. Morgan stock he was granted as compensation. He preached long-term ownership. He told investors that CEO stock sales signal lack of confidence. He structured his own compensation to be 80% in stock. Specifically to align with shareholders. He was the ultimate believer. In 2024, that changed. In February, J.P. Morgan disclosed that Dimon would sell 1 million shares. The stock was trading around $155 to $165. Total value, approximately $160 million. The official reason? Estate planning and diversification for his family. Dimon is 68 years old. But he could have done estate planning in 2010 2015 2020 anytime. And here's what should terrify you. Jamie Dimon has more information about the real economy than almost anyone alive. JP Morgan is the largest bank in America with $3.9 trillion in assets. Dimon sees everything. Loan defaults across every sector. Commercial real estate delinquencies. Corporate bankruptcies. Small business failures. He has real-time data on the economy that won't appear in government statistics for months. And for the first time in 18 years, he's selling. That's not estate planning. Larry Ellison. Oracle Ellison, co-founder and chairman, sold approximately $3 billion in Oracle stock during 2024. Oracle surged on AI infrastructure demand. Every company building AI needs databases, cloud services, and computing power. Oracle provides all three. The stock went from $80 in early 2023 to over $140 by late 2024, nearly doubling. And at the peak, Ellison. Who's been with Oracle since founding it in 1977, is selling billions. Ellison is worth over $150 billion. He doesn't need liquidity. He is selling because Oracle at 140 is overvalued relative to what he knows about the company's real growth trajectory. The Walton family, Walmart. In 2024, various members of the Walton family sold over $2.3 billion in Walmart stock. Jim Walton sold $1.5 billion. Alice Walton sold $500 million. Rob Walton sold $300 million. These are the children of Sam Walton, who founded Walmart in 1962. The family has held stock for 62 years through every market cycle. They rarely sell significant amounts because Walmart is the family legacy and a reliable dividend machine. But in 2024, all three siblings executed large sales within months of each other. Walmart stock hit all-time highs above $80 per share. The family is cashing out. NVIDIA insiders. This is perhaps the most extreme example. The pattern is undeniable. The most successful operators of our generation, people who built trillion-dollar companies, people who've held stock for decades, are all selling at the same time. And the total amount is staggering. Total insider selling in 2024 reached $464 billion. That's the second highest year on record. The highest was 2007 at $650 billion. Let me repeat that. The year before the worst financial crisis since the Great Depression. The year before the S&P crashed 57%. That's the only time in history when insider selling exceeded 2024 levels. 2025 is on pace to exceed even 2007. If the current rate continues. Now let me show you the 5 historical patterns that prove insider selling predicts crashes. Because this isn't coincidence. This is science. Pattern 1. Insiders sell 12 to 24 months before major market peaks. The data is overwhelming. In 1987, before the October crash, insider selling spiked 350% in the first half of the year. The market peaked in August. Crashed in October. Insiders sold 6 to 8 months early. In 2000, before the dot-com crash, insider selling hit records in late 1999 and early 2000. The NASDAQ peaked in March 2000, then fell 78% over 2 years. Insiders sold at the top. In 2007, insider selling reached $650 billion. The market peaked in October 2007. The S&P fell from 1565 to 666 by March 2009, a 57% decline. Insiders sold 6 to 12 months before the peak and 12 to 18 months before the bottom. The pattern is consistent. Insiders see problems developing. They sell while prices are still rising. The market continues up for months because retail investors and institutions are still buying. But the insiders are gone. Then the crash comes. The insiders who sold at 90 to 100% of peak prices watch from cash as stocks fall 50 to 60%. Then they buy back at the bottom. This is how wealth is transferred from the public to the insiders. Sell high. Wait. Buy low. Pattern 2. The sell-to-buy ratio spikes above 8 to 1 before crashes. The Washington Service has tracked this since 1975. Every time the ratio exceeds 8 to 1 for an extended period, a crash follows within 24 months. In 1987, the ratio hit 9 to 1 in June. Crash came in October. In 2000, the ratio hit 11 to 1 in Q1. The crash started in March. In 2007, the ratio hit 8 to 1 by mid-year and spiked to 10 to 1 by fall. The crash started in October. The pattern is perfect. 8 times since 1975. The ratio exceeded 8 to 1. 8 times a crash followed. 0 false signals. Right now in 2024, the ratio hit 9 to 1 for the full year. In Q3 2024, it spiked to 12 to 1. This is the most extreme reading since 2007. If the pattern holds, and it's held for 50 years, a crash is coming within 24 months. That means late 2025 or 2026. Pattern 3. Insiders in the most overvalued sectors sell first. In 2000, tech insiders sold while the NASDAQ was still soaring. They knew valuations were insane. Companies with no profits trading at 100 times sales. It was obvious to insiders. So they sold. Tech crashed 78%. Other sectors fell but less. In 2007, financial sector insiders sold first. CEOs of Lehman, Bear Stearns, Countrywide. They all sold in 2006 and 2007. They knew their companies held toxic assets. They got out. Financials crashed 80% plus. Other sectors fell 40 to 50%. In 2024, what sectors are insiders selling? Tech and financials again. Nvidia. Meta. Amazon. Oracle. Tech. All selling. JP Morgan is financials. This tells you which sectors are most overvalued and most at risk. Tech is in an AI bubble. Valuations assume infinite growth. Insiders know it's unsustainable. Financials are sitting on commercial real estate time bombs. Insiders know the loans will default. They're selling both sectors. That's your roadmap. Tech and financials will lead the crash. Pattern 4. When the most successful long-term holders sell, the top is in. Bezos held Amazon for 30 years. Zuckerberg held Meta since founding in 2004. Dimon held JP Morgan for 18 years. Ellison held Oracle for 47 years. These aren't traders. These are builders who held through every crash. The fact that they're selling now means they believe current valuations are as good as it gets. They've lived through 2000, 2008, 2020. They know what crashes look like. And they're choosing to sell now. That means they see 2024 and 2025 as a generational top. When the greatest long-term holders in history become sellers. The market is topping. Pattern 5. Massive insider selling is never followed by new highs within 24 months. This is the killer stat. Since 1975, every time insider selling exceeded $400 billion in a year, the market either crashed within 24 months or entered a multi-year bear market. 1987. $180 billion in insider selling adjusted for market size. Crash in October. 2000. $325 billion adjusted. Crash starting March. 2007. $650 billion. Crash starting October. The market did not make new highs after any of these episodes for years. After 1987, new highs took 2 years. After 2000, new highs took 7 years. After 2007, new highs took 6 years. 2024 insider selling $464 billion. If the pattern holds, the S&P will not make new highs above the 2024 to 2025 peak for at least 3 to 5 years. You're either at the top now or within months of it. Everything after is decline and recovery. The insiders are telling you this with their sales. Now, let me show you what the billionaires are seeing ... you're not. Because they have access to data and analysis that retail investors never see. First, they see the Buffett indicator screaming overvaluation. This is Warren Buffett's preferred market metric. Total stock market capitalization divided by GDP. When stocks are worth more than the entire economy's output, it's overvalued. The historical average is 80 to 100%. Above 120% is expensive. Above 150% is bubble territory. The Buffett indicator currently sits at 185%, the highest in history, except for the brief COVID spike. This means stocks are valued at nearly double the economy's output. For this to be sustainable ... you need to believe either the economy will grow 50% while stocks stay flat, or B, corporate profit margins will double from here. Neither is realistic. Profit margins are already at record highs. GDP growth is slowing. The indicator must revert to the mean. Mean reversion from 185% to 100% means stocks fall 46%. The billionaires see this. Now you see it too. Second, they see the Shiller pay at bubble levels. The Shiller PE ... also called CAPE, cyclically adjusted price to earnings ... measures stock prices relative to 10 years of inflation-adjusted earnings. It smooths out economic cycles and shows long-term valuation. The historical average is 16 to 17. Below 12 is cheap. Above 25 is expensive. Above 30 is bubble territory. The Shiller P currently sits at 34. Only 3 times in history has it been higher. 1929 ... peaked at 33 ... then crashed. 2000 ... peaked at 44, then crashed 50%. And briefly during COVID peaked at 38, then fell 35%. Every time the Shiller P exceeded 30, a crash followed within 3 years. You're at 34 right now. The billionaires know history. They're selling. Third, they see margin debt at dangerous levels. Margin debt is money borrowed to buy stocks. When investors are bullish ... they leverage up. When they're bearish, they deleverage. Margin debt hit $950 billion in late 2024, near all-time records. This is dangerous because leverage amplifies both gains and losses. If stocks rise 10%... leverage investors make 20%. But if stocks fall 10%, they lose 20%. And if stocks fall 30%, they get margin calls. Brokers force them to sell to cover loans. This creates cascading forced liquidation. In 2008, margin debt was $850 billion at the peak. As stocks fell... margin calls forced selling. The selling pushed stocks lower. More margin calls. More forced selling. Margin debt collapsed from $850 billion to $280 billion in 18 months. That $570 billion in forced selling accelerated the crash. Right now, ... you're at similar levels. The billionaires know when the market turns. This $950 billion in leverage will become forced selling that accelerates the decline. So they're exiting before the cascade. Fourth, they see commercial real estate collapsing. Office buildings sit 40 to 50% vacant due to permanent remote work. Buildings bought in 2019 to 2021 at peak prices with 3% mortgages are now worth 40% less. Those mortgages are maturing. Owners need to refinance at 7 to 8%. The math doesn't work. Fifth, they see a corporate debt refinancing crisis. U.S. companies owe $13.5 trillion. Much of it was borrowed at 2 to 3% interest during 2009 to 2021. Those bonds are maturing. They must be refinanced at 6 to 8%. Companies that could afford 3%... Can't afford 7%. They'll default. You're seeing this already. Corporate bankruptcies in 2024 hit levels not seen since 2010. Bed Bath & Beyond, Party City, Rite Aid, Silicon Valley Bank, dozens of smaller firms. And the wave is just starting. $4.7 trillion in corporate bonds mature between 2024 and 2026. If even 10% default, that's $470 billion in losses. Bond prices crash. Credit spreads blow out. This cascades to stocks. Companies that can't refinance go bankrupt. Stock goes to zero. The billionaires running these companies see their own balance sheets. They know which ones can't refinance. They're selling before the defaults accelerate. 6. They see federal debt spiraling. The U.S. government owes $36 trillion. The deficit is $2.4 trillion per year. Interest payments hit $1.2 trillion annually, more than you spend on defense. By 2027, if rates stay at 5%, interest hits $1.8 trillion. This is mathematically unsustainable. The government must either A. Cut spending by $2 trillion. Politically impossible. B. Raise taxes massively, economically destructive. Or C. Print money, causing inflation and dollar devaluation. None are good. All are destructive. The billionaires know the debt spiral ends in crisis. Currency collapse. Or both. They're converting to hard assets and diversifying out of pure dollar exposure. 7th, they see their own company's internal data deteriorating. This is the secret sauce. Bezos sees Amazon's real sales growth slowing, not the reported numbers. The real internal daily metrics, advertising revenue growth decelerating, margin compression, AWS cloud growth slowing as enterprises cut costs. Zuckerberg sees Meta's real engagement metrics, time spent declining, at pricing under pressure, AI costs exploding without clear ROI. Dimon sees JP Morgan's real loan quality, delinquencies rising, charge-offs increasing, commercial real estate losses mounting. This is proprietary data. You won't see it until quarterly earnings in 3 months. By then, the stock will have already fallen. The insiders are selling now because the internal data says growth is slowing. Margins are compressing, and stocks are overvalued relative to future earnings. These 7 data points tell the same story. Stocks are overvalued by 40 to 50%. The economy is slowing toward recession. Corporate and commercial real estate defaults are accelerating. Federal debt is unsustainable. And internal company data is deteriorating. The risk-reward for holding stocks is terrible. Potential upside, maybe 10 to 20% if the bubble continues. Potential downside, 50 to 60% when it crashes. When you're already worth $200 billion like Bezos. Risking $10 billion to make $1 billion more doesn't make sense. Better to sell. Preserve capital. And buy back after the crash at 50% off. Now let me show you the timeline. Based on historical patterns, when does the crash come? The average lag between peak insider selling and market crash is 12 to 18 months. In 1987, heavy selling in Q2. Crash in Q4, 6 months. In 2000, heavy selling in Q4 1999 and Q1 2000. Crash started March 2000. Immediate. In 2007. Heavy selling throughout 2007. Crash started October 2007. Concurrent. The pattern shows a 6 to 18-month lag. 2024 saw massive selling throughout the year, especially Q2 and Q3. If the pattern holds. The crash window is Q2 2025 through Q2 2026. That's 6 to 18 months from peak selling. But there are additional timing factors. Presidential election cycles matter. Markets tend to peak in the second or third year of presidential terms. 2025 is year 1 of a new term or second term. Year 1 often sees volatility. The real danger is year 2. 2026. Commercial real estate defaults peak in 2025 to 2026 as mortgages mature. Corporate debt refinancing crisis peaks 2025 to 2026. Federal deficit continues exploding through 2025 to 2026. All these crises converge in the 12 to 24-month window ahead. My estimate: the crash begins somewhere between Q3 2025 and Q2 2026. The trigger could be anything: a major bank failure, a corporate debt default cascade, a commercial real estate panic, a geopolitical shock. The trigger doesn't matter. The system is fragile. Any shock starts the cascade. And once it starts, forced liquidation amplifies it, margin calls, algorithmic selling, ETF redemptions, panic. The S&P could fall 30 to 50% in 6 to 12 months. Now let me show you who wins and who loses. Who wins? The billionaire insiders who sold in 2024. Bezos sold $13 billion at $170 to $180. If Amazon falls 50%, it goes to 85 to 90. He can buy back twice as many shares. He doubles his stake for the same money. Zuckerberg sold $9 billion at $450 to $500. If Meta falls 50% to 225 to 250, he buys back at half price. Dimon sold at 155 to 165. If JP Morgan falls 40% to 95 to 100, he buys back and makes 50% on the round trip. This is the game. Sell high, wait for crash. Buy low, increase stake. The billionaires who sold in 2024 will be wealthier after the crash than before, because they'll own more shares bought at lower prices. People who hold cash and gold win. Cash is dry powder. When stocks crash 50%, cash buys assets at half price. This is when generational wealth is created, not by panic selling at the bottom, but by buying quality assets at distressed prices. Gold preserves purchasing power. When the crash comes, the Fed will print trillions to bail out the system. That money printing devalues the dollar. Gold maintains value. People who allocated 10 to 20% to gold protect wealth, while stock investors lose 50%. Short sellers win. Those betting against overvalued stocks. Michael Burry made $700 million shorting subprime mortgage in 2008. John Paulson made $15 billion. Bill Ackman made $2.6 billion in March 2020 shorting credit. Short sellers who correctly identify the crash profit enormously. But this is high risk. Timing is everything. You can be right about the crash, but wrong about timing, and lose everything. Most people shouldn't short, but professionals who time it right make fortunes. Who loses? The middle class loses the most. And here's where this becomes personal for you. Your wealth likely sits in 3 places: your 401k retirement account, your home equity, and your savings. All 3 get crushed. Your $401,000 is probably 70 to 80% in stocks. If you're 65 with $800,000 saved, planning to retire in 2025, and the market crashes 50%, you now have $400,000. You can't work. You can't rebuild. Your retirement is destroyed. You'll spend your final years struggling, despite saving responsibly for 40 years. This is the human cost. Millions of responsible savers destroyed by timing. They were unlucky enough to retire at the top. Do you really think you can afford to ignore the same signals the billionaires are acting on? Pension funds and institutions lose. CalPERS. The California Public Employee Pension manages $470 billion. If stocks fall 50%, they lose $200+ billion. Benefits get cut. Municipalities go bankrupt. Retirees get pennies on the dollar. Insurance companies hold billions in stocks and bonds. When both crash, they become insolvent. Policyholders lose coverage. This cascades through the system. Everyone interconnected loses together. Leveraged investors get annihilated. Anyone who borrowed to buy stocks. If you bought $100,000 in stocks with $50,000 in margin debt, you own $100,000 with $50,000 borrowed. If stocks fall 50%, your $100,000 becomes $50,000, but you still owe $50,000. Your equity is zero. You get a margin call. You must sell at the worst possible time, locking in total loss. This is the wealth transfer. From the middle class to billionaires, from the unprepared to the prepared, from those who didn't see the pattern to those who did. So what do? You can't stop the crash, but you can position to survive it and profit from the recovery. First, reduce your equity exposure. If you're 80% stocks, reduce to 40 to 50%. Raise cash. Yes, You might miss gains if stocks rise another 10 to 20%, but you'll preserve your capital when they crash 50%. The billionaires are raising cash. You should too. Second, hold 10 to 15% in gold. Physical gold or GLD ETF. When the crash comes and the Fed prints trillions, gold surges. It did in 2008 to 2011, doubled. It did in 2020 to 22, up 50%. It will again. Gold is insurance against monetary chaos. Third, have a buy list ready. When stocks crash 40 to 50%, when everyone is panicking, you need to know what you're buying. Quality companies with strong balance sheets. Apple, Microsoft, Visa, Costco, Johnson & Johnson. Make the list now. When the crash comes, deploy your cash systematically into these names at half price. Fourth, don't short unless you're an expert. The billionaires aren't shorting. They're selling and raising cash. Shorting requires perfect timing. The market can stay irrational longer than you can stay solvent. Just sell. Raise cash. Wait. Fifth, protect your job and income. Build an emergency fund of 12 months' expenses. In a recession with 10% unemployment, you might get laid off. Having cash reserves lets you survive without forced selling of investments at the bottom. 6. Position yourself psychologically. The crash will be terrifying. Media will run 24/7's crisis coverage. Your friends will panic. Your $401,000 will be down 50%. You'll want to sell at the bottom. Don't. That's when you buy. Prepare mentally now, so when the crash comes, you can act rationally while everyone else panics. What would your life look like if you lost half your retirement savings in the next 18 months? Let me end with this. The billionaire exodus is real. $50+ billion in sales from the world's most successful investors. $464 billion in total insider selling. Second highest year ever. Sell to buy ratio at 9-1. Most extreme since 2007. This is not normal. This is not diversification. This is the smart money screaming at you. Get out. They see the Buffett indicator at 185%. Schiller P at 34. Margin debt at records. Commercial real estate collapsing. Corporate debt refinancing crisis. Federal debt spiraling. Their own company's data deteriorating. And they're selling. The pattern from 2007 is repeating. Exactly. Heavy insiders selling 12 to 18 months before the crash. You're in that window right now. The crash is coming. Q3 2025 through Q2 2026 is the danger zone. Maybe sooner if a catalyst appears. Maybe later if the bubble extends. But it's coming. The billionaires are telling you with their actions. $13 billion from Bezos, $9 billion from Zuckerberg, first ever sale from Dimon. They're not wrong. They're early, but they're not wrong. If you're still watching right now, you understand something most people don't. You've seen the pattern. You know that the largest insider selling event since 2007 is happening right now. And you have a choice. Ignore the signal and hope you're lucky. Or recognize the pattern and position accordingly. Reduce your equity exposure. Raise cash. Hold gold. Make your buy list. Prepare psychologically. Because over the next 12 to 18 months, everything changes. The billionaire exodus has begun. The pattern is clear. The crash is coming. Are you going to be ready, or are you going to be a victim? Position yourself accordingly. I'm Walter Grant. This has been Draxiver.